Hello and welcome to our end of September update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build our wealth. I'm David Ye, author of the book Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those of you who are new to the concepts in the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we're going to continue a topic of the month that we've been discussing for the last 4 months. Then we'll review the various risk mitigating systems that we run. For instance, review the 20-month simple moving average system. Then we'll review the MRI, or the monthly rotation investment system. Then we'll touch base about the 25% trailing stop loss system, and then remind ourselves about sector surfer. So from our main video, we had this example of how if we saved $1,000 a year at 8% per year, growing like so, at year 15, let's say we had a $29,324 something we needed to purchase. Home, car, college expenses, something. And if we paid with cash, we would go down to zero and we have to start all over again. Whereas if we took out a loan instead at 4% interest per year, which required an outflow of $2,602.92 per year compared to $1,000 that we're saving per year, we'd actually end up with $29,000 with the first case and $37,000 the second case. Now this is a hypothetical example. Nothing grows in a straight, linear, or exponential fashion like this. But the lesson is, at some point, with enough capital mass, it is possible to net withdraw each year and still accumulate capital. Then we looked at two hypothetical cases. Connie and Daphne, they both live in two different universes. One has stock index historically performed thus, and one has stock index performing this way, only flipped. So for instance, over here, year 1, 2, and 3, Connie lost this much amount of money, whereas Daphne doesn't lose that until year 23, 24, and 25. They both average annualized 8.03% per year. However, if both of them started with $500,000 and they withdrew 5% per year, indexed to inflation, in other words, every year add 3% more to how much they withdraw, Connie, by withdrawing that much every year, suffering these stock market losses or gains, eventually runs out of money at year 20. Whereas Daphne, with a different order of return, different sequence, actually makes money despite withdrawing all the way to when she's 89 years old and still has enough capital mass to keep on withdrawing for probably the rest of her life. Well, what if we took Sally's case, which is exactly like Connie's, same market return, same order of return, same annualized 8.03% return, same $500,000 in the beginning, but every time there's a market loss, instead of taking money out of here, we keep it in the market and withdraw somewhere else. So every time there's a loss, take out here. Every time there's a loss, take out here. Fourth year, it's actually made money, so we take out the same amount of indexed 5%, which is $27,318, and keep withdrawing every year until, whoops, another year, there's another loss. So this year, don't take any money out. But next year, there's a gain. So now, withdraw money again. So on and so on until there's a loss, don't take money out there. Keep withdrawing until there's a loss, don't take money out that year. So on and so forth. Just by avoiding the losses, in other words, don't lock in the losses by withdrawing, it is possible to prolong the ability to withdraw from this particular nest egg. But wait a minute, if this is our saving system, if this is our retirement system, where are we going to be getting these funds to make up for these losses? Well, remember, we were also talking about a three-bucket system. There are other systems out there, but it boils down to having a security bucket, which is a bucket of funds where you don't take risk with it. It either grows a little bit or not at all, but safely. And we use this bucket for emergencies or for fixed short-term goals, such as college expenses or knowing that a roof needs to be replaced within the next year or so. And then, of course, you have the growth or risk bucket. We say growth risk just because growth does carry risk of loss. And then, of course, the dream bucket, which is why we save and invest to begin with. This is the how to live. This is the why to live. So remember, life is a balance of these three buckets. So life and financial balance. Just remember, if the plan isn't fun, it probably won't stick. But we have certain rules, such as spend less than you make. Of course, every rule has exceptions, such as if you have enough critical capital mass to be able to withdraw more than you put in, then for certain cases, go ahead and do that. Remember, pay yourself first, then spend the rest. And make sure your spending plan, instead of using a budget, we say spending plan, includes funding emergency fund, which is your safety bucket. And rule number 2 are those rules we had in dealing with large purchases. So dealing with large purchases can be anything from mortgage to investment opportunity that shows up and you need cash fast, to emergencies where you need cash fast, where you have goals and dreams. And of course, there's retirement, the ultimate large purchase. So let's get on with our systems. So the first system that we're monitoring is the 20-month simple moving average system. In other words, the rules are if the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay in the stock market fund. However, if the S&P 500 index goes below the 20-month moving average, then it's relatively dangerous, and we should get out, and we should either stay in cash or go to bonds. But this only works if we diligently look at this once per month. Don't let it slide, but don't look at it more than once a month. So here's our updated graph. This month, the VFINX, which is the Vanguard S&P 500 index fund that we follow, is at $200.21 per share. The moving average has moved up to $188.88 per share. So for those of you who are curious, that means we have a 6% cushion between where the stock is right now and when it becomes dangerous at the end of next month. So the observations of this month: the more time in between trades, the larger probability of growth. There were no whipsaws this month. So next system is the monthly rotation investment system, abbreviated the MRI system. And what this system entails is every month rank 3 funds: the VFINX, which is the Vanguard S&P 500 Index Fund, the VEIEX, which is the Vanguard Emerging Markets Index Fund, and the RYURX, which is the inverse S&P 500 Index Fund. Whichever one is the greatest, we sell the bottom 25% of our portfolio and buy the top fund. So here's how we're doing. Last month's data, this month's data. Last month, the S&P 500 index lost 0.4%. So markets went up, markets went down, and ultimately pretty much stayed almost exactly flat. Same with the inverse fund. It also lost 0.2%. Well, wait a minute. The index fund lost money. The inverse fund also lost money. Well, yes, remember that This is an artifact because when the index fund is supposed to go up when the inverse goes down approximately the same amount each day. If the index goes up 1%, for instance, the inverse is supposed to go down 1%. Remember that losses are larger than we think. If we lose 1%, we have to make 1.01% just to break even. If we lose 10%, we have to make 11% just to break even. Those little losses catch up, and that's why our losses are usually larger than the gains that we make. And then, of course, this month, the emerging markets is the clear winner, although not by much. But technically, it is still the winner. So, here's where we left off last month. We were 100% in the emerging markets fund. This month, since we're supposed to buy the emerging markets fund, since we're already 100%, we have no trade this month. Just keep it all in the emerging markets fund. So the observations of this month, the US emerging markets have been, again, sideways. The emerging markets just a little bit more volatile, and this was why it's a little bit higher this month. And the fact that all three funds are neck and neck may be interpreted in different ways. But why suffer the brain damage of trying to interpret when we can just follow the mechanical system and take the emotion out of investing? So the next system is a 25% trailing loss system. The rules for this one? Let's say you really want a stock. Well, don't invest more than 4% into any one position because you want to have a 25% trailing stop loss. This way, as stocks go up, the trailing stop goes up. If the stock goes down 25%, you're stopped out. 25% of 4% is 1%. If you lose only 1% per position, you'll live to trade another day. Biggest mistake I see other people doing is instead of using only 4% of their portfolio by a stock, they see something that thinks is a surefire win and they put in half their account or maybe their entire account into that one stock. That is a lot of risk. You can mitigate risk just by sticking to these two rules so far. And if the stock goes up by 33%, you can go ahead and buy another block using another 4% of your account and update your trailing stop loss order to reflect the increased number of shares and keep repeating until you're stopped out. Next system, this is a fourth system now, completely different system. It's a sector surfer system that we first introduced back in June. It's another sector rotation strategy. It's a different enough system that it complements the other systems that we've been following. Diversify among systems. So in other words, if you have several accounts, instead of diversifying assets within each account, you diversify one system in one account, another system in another account, etc., etc. This way, if any one system has a flaw with a particular market, chances are the other accounts may be relatively safe because they all have different risk mitigation systems. So with Sector Surfer, if the Sector Surfer strategy is set up properly, you will get a text or email. Of course, knowing me, I'm old school. I don't trust technology that much, so I do log on every so often just to make sure I don't miss a signal. And please check your Sector Surfer accounts this month. I already got one signal so far. So in summary, remember, what I just went over are different systems. Don't mix up systems. They are the 20-month moving average system, the MRI or monthly rotation investment system, different rules, trading same things but different rules, dealing with stock tips, different rules, and then monitoring sector surfer strategies, again, different rules, different ways of dealing with risk. So keep those questions coming. I know that I talk to several of you personally each month, but for those of you who have only heard about me indirectly, or maybe got a copy of this video forwarded to you by a well-meaning friend or a colleague, here are ways to contact me. Get in touch with me. Drop me a line. Seriously. Guys, send me an email. Set up a consult. A few of you who I've talked to You know your stuff. I don't have to worry about you. But for some of you, holy cow, it's clear you need to get your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.